Today, let's start with one of my favorite topics, given my strong belief that OPEC's highly visible death throes presage the epic level of chaos the gold cartel will eventually experience when it spectacularly fails, per what I wrote in last month's OPEC, like the London gold pool, proving cartels always fail. To that end, no blog I am aware of, outside of those focused principally on energy, has expanded more digital ink on this topic, given how confident that, contrary to the all-time high long position Wall Street took in crude oil futures earlier this year, the production cut required to save not only the energy industry, but countless sovereign nations, would miserably fail, no matter how much propaganda and market manipulation was expended to create the perception of balance, amidst history's worst, and likely, irreversible, crude oil glut. This morning, it was reported that OPEC's May crude oil production, the very month they extended the initial, completely futile 6-month cut by an additional 9 months, rose by a whopping 336,000 barrels per day, to its highest rate of 2017. Non-compliance was a major factor, and now that head OPEC bully Saudi Arabia has all but declared war on Qatar for no apparent reason, other than its strong allegiance with Saudi's mortal enemy, Iran, future compliance will unquestionably be lower. However, the biggest contributing factor to May's production surge, if you believe a word these lying, thieving lowlifes say, is the restoration of lost supply from members exempt from the initial Vienna deal, like Iran, Libya, and Nigeria. In other words, they, and Iraq, which is not exempt, are doing exactly what they said they would do, which is exactly why said deal was such a farce to start with. And consequently, why the energy sector is about to cause an unfathomable amount of pain in the political, economic, social, monetary, and perhaps military spheres. Which in turn, will give central banks the perfect deflationary excuse to extend, and expand, their hyperinflationary monetary policies ad infinitum, in perfect synchronization with the mandate of their fiat Ponzi schemes. This is exactly what Goldman Mario blamed on his decision to lower the ECB's short and long-term inflation expectations last week, taking central bank credibility to a new all-time low, and will give Janet Yellen yet another quiver in her money-printing arrow when the FOMC meets today and tomorrow. Heck, oilprice.org just published an article titled "Low Interest Rates Have Postponed Peak Oil," demonstrating why the inescapable feedback loop of low oil prices, low inflation expectations, and low interest rates, not to mention dramatic technology advances, will continue to add to the glut for the foreseeable future. Furthermore, with each successive OPEC failure, the inevitable collapse of the dying petrodollar moves one giant step forward. Frankly, it couldn't be more obvious that America values its rapidly deteriorating relationship with Saudi Arabia ahead of nearly all others, given that it provides a steady source of oil, b. a strategic Middle Eastern ally, c. a point man to coordinate its relentless Middle East wars, and d. a steady demand for fiat dollars to purchase Saudi crude. In my mind, this is the primary reason Saudi Arabia was a top contributor to the Clinton Foundation, and why, despite blatantly anti-Saudi campaign rhetoric, Donald Trump feted Saudi Arabia's criminal princes last month, lavishing them with the record arms contract so they can wage war on whomever their puppet masters at the Pentagon choose. Moreover, it is clearly the principal reason why an ad hoc oil PPT was created last year when prices plunged, given that Saudi Arabia's finances, even at $50/barrel oil, are rapidly deteriorating, yielding the dire, desperate need to IPO a $100 billion stake in Saudi Aramco later this year. Which, with each passing day, appears more and more unlikely. To that end, I have always viewed Saudi Arabia as a political apartheid society, in which a handful of sociopathic, money-hungry leaders ally themselves with the great Satan America, against the wishes of the vast majority of U.S.-hating citizens. It can only end badly, very badly, and in my view, will do so, very soon. Just as will be the case with U.S. monetary policy, on this eve of yet another Keystone Cops FOMC meeting, when World Leader Janet issues the Fed's last rate hike of her soon-to-end tenure, and potentially the last tightening before the inevitable arrival of the bond vigilantes forces her to do so, into extreme economic weakness and political strife. Which is saying a lot, given that the past decades, accounting-enhanced GDP growth was identical to the 1930s, despite the $15+ trillion of debt piled onto individuals, as evidenced by total household debt hitting a new all-time high last month. Institutions, municipalities, like the state of Illinois, which appears likely to declare bankruptcy sooner rather than later, corporations, which now have more debt than at any time in U.S. history, and of course, the federal government itself. Everywhere one looks, evidence that even the minuscule rate hikes that took the Fed funds rate from its 8-year convalescence at zero to the current level of 0.87%, 18 months after the first rate hike, which just happened to coincide with precious metals' ultimate bottom, suggests the result of this ill-begotten policy has been miserable, expanding failure. As not only have said hikes decimated already overburdened debt loads, giving way to exploding auto, student, and credit card delinquencies and defaults, but they have further exposed how historically overvalued central bank-supported stock and bond markets have become, as well as the real estate markets that piggyback off them, that is, .com valuations in a Great Depression era. To wit, despite the supposedly strong, growing economy, featuring barely positive GDP, and collapsing hard data of all kinds, the CRB commodity index is breaking below support levels going all the way back to the start of 2016, when said oil PPT was established in a desperate effort to prop up the CRB's most heavily weighted component, which in February 2016, bottomed at $26/barrel, and in the process, save its despotic, murderous, petrodollar processing ally, Saudi Arabia. Moreover, delinquencies, defaults, and bankruptcy filings are exploding, whilst year-over-year loan growth is about to go negative for the first time since the 2008 crisis, and as we learned yesterday, barely a quarter of all U.S. businesses are in the black. The U.S. government budget, also reported yesterday, is exploding higher, too, before tomorrow's rate hike is even announced. Much less the tax cuts and infrastructure spending components of the dead and buried Trumpflation meme, which, as I vehemently predicted 2 days after the election, have not a chance of occurring anyway. Which, if against all odds were actually enacted, would practically speaking, make the budget and debt situations far worse. Throw in the imminent, and likely massive debt ceiling increase coming this summer, which just yesterday, slimebag Steve Mnuchin practically begged for head of Congress' upcoming August recess, and the inexorable plunge in retail sales, corporate capital expenditures, and even housing permits, starts, and sales, and you can see why tomorrow's rate hike, which the Fed is only enacting because the PPT has been able to boost the Dow Jones propaganda average to an all-time high bubble valuation, will clearly be the last. However, of all the reasons why tomorrow's rate hike will be the Fed's last, none loom larger than the giant pink elephant in the room. Which is, that for all the previous rate hikes, market support, and propaganda of great things to come, not only have real economic data and commodity prices relentlessly plunged, but so have actual, market-based interest rates. The height of the benchmark 10-year Treasury yield, going all the way back to early 2014, was the also-brief spike to 2.6% just after the election, and again, leading up to the March rate hike, before it promptly plunged to the roughly 2.2% it stands at today. To that end, my 2.5%, enough said article of January 2017, calling the top in the 10-year yield, is looking just as prescient as my similarly themed 3.0%, enough said article of January 2014, in light of the fact that real-world indicators suggest that not only is the current, historically ineffective credit cycle is at its end, but so is the Fed's LOL, tightening cycle as well. Yes, a tightening cycle, amidst a collapsing global economy, that will have taken 18 months to simply raise rates from 0% to 1%, the latter of which, even Maestro Greenspan never went below during his berserk rate-cutting crusade following the historic .com collapse, which he, more than any single person, personally fostered. And if you don't believe interest rates themselves, then look at the collapse of the yield curve post-election day, to nearly a new multi-year low, not just in the US, but all major Western nations. In my view, the past week's historic precious metal paper raids, amidst a veritable cornucopia of pine-beeb news flow, was undertaken for two principal reasons. First, to push gold back below its 5.5-year downtrend line at roughly $1,274/Us, just as it approached the key psychological level of $1,300/Us, and silver, its 200-week moving average of $17.75/Us, both of which were briefly achieved last Wednesday, before someone dumped $4 billion of notional paper gold on the COMEX Thursday morning, after the wildly dovish ECB statement, to catalyze the typical spec margin calls that lead to prototypical waterfall declines. And equally important, to prime the market for tomorrow's rate hike, yet again, trying to convince it this is bad for precious metals, despite not a shred of evidence to support the notion, or the fact that PM surged after all three previous rate hikes. In other words, I sense a significant opportunity to acquire dirt cheap insurance at today's historically suppressed prices, of physical gold, silver, and a forgotten precious metal, per yesterday's article title, Platinum.